The question is whether you should invest a large sum of money all at once or spread it out over time through dollar cost averaging. And today I am going to tell you exactly what the data says without softening the answer to make it more comfortable. Let me start with the most important study on this topic because everything else in this debate flows from what Vanguard found when they actually looked at the historical data. Vanguard Research analyzed 21 rolling 12-month periods across the United States, United Kingdom, and Australian markets using data spanning from 1926 to 2022, comparing two strategies for deploying a lump sum of capital. Strategy 1. Invest the entire amount immediately on day 1. Strategy 2. Spread the same total amount equally across 12 monthly installments over 1 year, which is the classic dollar cost averaging approach. The result was consistent across every market tested, every time period studied, and every asset allocation examined from all equity to balanced to conservative portfolios. Lump sum investing outperformed dollar cost, averaging approximately 2/3 of the time, with an average outperformance of approximately 2.3% over the deployment year for a balanced 60-40 portfolio and approximately 2.4% for an all-equity portfolio. That is the data. Lump sum wins 2/3 of the time. The debate is not actually close when you look at the full historical record. But here is where I want to be more honest than most content on this topic, because the remaining 1/3 of the time when dollar cost averaging wins is not random noise. Dollar cost averaging wins specifically and consistently during the 1/3 of historical periods when markets decline during the deployment window. When you spread your investment over 12 months and markets fall during that period, you automatically buy more shares at lower prices in the later months of your deployment schedule, which means your average cost per share is lower than if you had invested everything at the original higher price on day 1. This is not magic. It is simple arithmetic, and it is the genuine mathematical advantage of dollar cost averaging that the data fully supports in declining market environments. The question is not whether lump sum or DCA is theoretically superior in the abstract. The question is which one is right for your specific situation given your psychological makeup, your current market environment, and what the consequences of being wrong actually are for your specific financial life. Let me now give you the complete framework for making that decision because I think most people have been asked to choose between these strategies without being given the actual decision criteria that should drive the choice. The first and most important factor is whether the money you are deploying represents a meaningful percentage of your total investable net worth. If you have $500 in investments and you receive a $50 bonus, that bonus represents 10% of your total investable assets. Deploying it all at once means that if markets fall 30% in the next 3 months, you lose $15 on that bonus, which is real money, but which represents only a 3% impact on your total portfolio. That is a manageable scenario, and the expected return advantage of lump sum over its deployment period likely justifies accepting that risk. If you have $50 in investments and you receive a $200 inheritance, that inheritance represents 400% of your previous total investable assets. Deploying all $200 immediately means that if markets fall 30% in the next 3 months, you lose $60, which is a psychologically devastating outcome that many investors would respond to by selling at the bottom and locking in the loss permanently. In this scenario, dollar cost averaging over 6 to 12 months is not just psychologically easier, it is structurally better because the mathematically superior strategy is worthless if you abandon it the first time markets move against you. The second factor is your current emotional state relative to the specific market environment you are deploying into. In July 2026, the S&P 500 CAPE ratio sits at approximately 39.6. The Buffett indicator is at approximately 217% of GDP, and we are navigating stagflation conditions with inflation at 4.2% and the Fed holding rates at 3.50 to 3.75%. In this specific environment, the 1/3 of historical periods when dollar cost averaging outperforms lump sum is more likely than it would be in a period of more normal valuations, because elevated valuations historically increase the probability of below average or negative near-term returns. Vanguard's own research acknowledges that when current valuations are elevated, the expected return advantage of lump sum narrows and the risk management benefit of DCA becomes relatively more valuable. The third factor is the source of the money and the psychological relationship you have with it. An inheritance from a parent, a divorce settlement, a business sale, or a serious accident settlement all carry psychological weight that goes beyond the financial numbers. Deploying $500 of inherited money immediately into a market that then falls 20% in the next 3 months is not just a financial event, it is an emotionally catastrophic experience for many people that can permanently damage their relationship with investing regardless of whether the eventual outcome is positive. In these situations, dollar cost averaging is a form of regret insurance that has a real financial cost, the expected 2.3% return disadvantage, but that has an equally real psychological benefit that prevents the behavioral mistakes that destroy more wealth than the 2.3% gap ever could. Let me now address the specific question that I know many of you are asking because it comes up constantly and deserves a direct answer. What about the investor who contributes from their paycheck every month? Is that dollar cost averaging, and does the Vanguard research apply to them? The answer is that paycheck investors are not making a DCA versus lump sum decision at all, and the Vanguard research does not apply to their situation. The Vanguard research specifically addresses the decision of how to deploy a lump sum that already exists, money you have right now that is sitting in cash waiting to be invested. A paycheck investor does not have a lump sum waiting to be deployed. They have a monthly cash flow that they are directing into investments as it arrives, which is the only rational thing to do with money that does not yet exist. The correct behavior for paycheck investors is always to invest their available savings immediately each month rather than accumulating cash and deploying it quarterly or annually, because any delay in investing money that is available means missing expected returns for no reason. This is what Vanguard means by their phrase dollar cost averaging just means taking risk later when applied to lump sums, but it does not apply to someone investing their monthly savings, because for them, there is no earlier moment when they could have invested the money since it did not yet exist. Now let me address the specific 2026 context for someone making this decision right now, because the current market environment is genuinely relevant to where the balance of evidence sits. In the current elevated valuation environment, the historical probability that markets deliver below average or negative returns over the next 1 to 3 years is higher than the base rate across all historical periods. This does not mean markets will fall. They may continue rising, as they did for 9 months after the CAPE ratio hit similarly elevated levels in 1999 before the eventual correction. But it does mean that the expected return advantage of lump sum over DCA is somewhat smaller than the 2.3% average from the full historical sample, because that 2.3% average includes periods of low, normal, and elevated valuations. And elevated valuation periods have historically produced lower average returns over the deployment window. The practical implication for a 2026 investor deploying a significant lump sum is that a 6-month DCA schedule rather than immediate lump sum is a more defensible choice than it would be in a period of normal valuations, and the behavioral insurance value of DCA is relatively more valuable given the genuine uncertainty of the current macro environment. This is not a prediction that markets will fall. It is a recognition that the risk-reward balance between lump sum and DCA shifts somewhat based on starting valuations, and in 2026, it shifts slightly more toward DCA than the base rate historical data alone would suggest. Let me now give you the specific framework for deciding which approach is right for you and exactly how to implement whichever you choose. If your lump sum represents less than 25% of your current investable net worth, and you have strong behavioral conviction to hold through any short-term decline, invest as a lump sum immediately into your target allocation and move on. The data says this is the higher expected return choice 2/3 of the time, and you have the financial and psychological cushion to absorb the scenario where it underperforms. If your lump sum represents between 25 and 75% of your current investable net worth, use a 3 to 6 month DCA schedule, investing equal amounts every month into your target allocation. This captures most of the lump sum's expected return advantage in the scenarios where markets rise, while providing meaningful protection against the behavioral collapse that often follows deploying a large sum right before a significant decline. If your lump sum represents more than 75% of your current investable net worth, or if it carries significant psychological weight as an inheritance, settlement, or once-in-a-lifetime event, use a 6 to 12 month DCA schedule. The expected return you give up by spreading the deployment is real, but small relative to the catastrophic behavioral risk of investing everything immediately and watching a life-changing sum lose 20 or 30% within months of deployment. In all 3 scenarios, the target allocation you are deploying into should be determined by your long-term investment plan, not by the DCA versus lump sum decision. You are not choosing between DCA and sitting in cash indefinitely. You are choosing between different schedules for deploying into the same target allocation that you have already determined is right for your long-term financial goals. The cash sitting in your account during a DCA deployment should be in a high-yield savings account or money market fund earning 4 to 5% rather than sitting idle in a zero-yield account, which reduces the opportunity cost of the DCA approach while you wait for each deployment date. At 4.5% on your uninvested cash during a 12-month DCA schedule, you recover approximately 2.3% of the expected return gap between lump sum and DCA through the interest earned on the cash waiting to be deployed. This means a 12-month DCA schedule in the current high-yield environment costs you almost nothing in expected return terms compared to the historical disadvantage, because the cash earns a competitive return while waiting, which was not the case when interest rates were near zero. This is an important 2026 specific insight that most DCA versus lump sum content ignores. The calculus shifted meaningfully when interest rates rose in 2022 and 2023, because uninvested cash now earns a real return rather than nothing, which reduces the opportunity cost of spreading a deployment schedule across months. Let me close with the most important behavioral insight from everything in this video, because it is the thread that connects the DCA versus lump sum debate to everything else we have covered across this channel. The reason most people ask the DCA versus lump sum question is not because they are trying to optimize a 2/3 versus 1/3 probability distribution. They are asking because they are scared. They have money available to invest. They know they should invest it. And every market headline in 2026 is making them feel like today is the worst possible time to put money to work. The DCA versus lump sum debate is often a sophisticated sounding framework for a much simpler underlying question, which is whether it is safe to invest right now. And the honest answer to that question, based on everything the data shows across 125 years of market history, is that the expected cost of waiting for a better moment is almost always higher than the expected benefit of getting a slightly better entry price. The markets go up more often than they go down. The expected cost of being out is almost always higher than the expected benefit of waiting. And the behavioral mistakes that happen when investors sit in cash waiting for the perfect moment destroy more wealth than any entry point decision ever could. Choose your strategy, implement it consistently, and let the mathematics of staying invested deliver what it has always delivered to investors who had the patience to remain present through every environment the market creates. Subscribe for the next video and see you there. Let me add one more dimension to the DCA versus lump sum debate that I think is genuinely underappreciated, and that changes the practical calculus in important ways. The Vanguard study compared two investors who both eventually deployed their full capital into the market, one immediately and one over 12 months. What the study did not model is the third scenario that represents the actual outcome for many investors who choose DCA as a risk management tool. The investor who starts a DCA schedule and then abandons it midway through when markets move in an uncomfortable direction. If you start a 12-month DCA schedule with $200 and markets rise 15% in the first 3 months, the psychological pressure to deploy the remaining 9 months of capital immediately rather than continuing to invest at higher prices is enormous. Many investors in this scenario abandon the DCA discipline and invest the remainder as a lump sum at higher prices than they would have paid on day one, getting the worst of both worlds, missing part of the initial rise and then deploying the majority at peak prices. If you start the same DCA schedule and markets fall 20% in the first 3 months, the psychological pressure to stop the DCA entirely and wait for further clarity before continuing is equally enormous. Many investors in this scenario pause or cancel their deployment schedule at exactly the moment when buying would be most beneficial, transforming what should have been the advantage of DCA into the disadvantage of market timing. These behavioral failures are not hypothetical edge cases. They represent the dominant actual outcome for investors who use DCA as an anxiety management tool rather than as a genuine disciplined deployment schedule. The only DCA that produces the mathematical outcomes the research describes is a DCA schedule that is implemented with complete automation and complete commitment, meaning you set up automatic monthly purchases on a specific date and you do not deviate from the schedule regardless of what markets do during the deployment period. If you cannot commit to that level of automation and discipline, a lump sum investment on day one is actually safer from a behavioral standpoint than a DCA schedule you are likely to abandon or modify in response to market movements during the deployment window. The DCA versus lump sum debate is ultimately a debate about which strategy you will actually follow through on rather than which strategy is theoretically optimal. The theoretically optimal strategy that you abandon is always worse than the theoretically suboptimal strategy that you implement completely. Now, let me also address something that comes up frequently in the 2026 context specifically, and that connects the DCA versus lump sum debate to the S&P 500 concentration risk we discussed earlier in this series. In a market where the top 10 stocks represent 41% of the S&P 500 and AI-related sentiment drives much of the index's short-term movement, the scenario where markets both rise and fall rapidly in short periods has become more likely than it was in periods of more even concentration. An investor who deployed their capital in equal monthly installments through that same period bought shares at progressively lower prices through the decline and at recovering prices through the subsequent rally, ending up with more shares than the lump sum investor at a lower average cost per share. This 2026 specific sequence of events does not overturn the vanguard finding that lump sum wins 2/3 of the time, but it does illustrate concretely why the 1/3 of the time when DCA wins matters, and why the current market environment, with its higher volatility and elevated concentration risk, shifts the balance slightly more toward the DCA approach for investors deploying significant new capital. Let me now give you the complete practical implementation guide because I want this video to end with something you can actually execute rather than just absorb as an interesting academic analysis. Step 1. Determine how large your deployment is relative to your current investable net worth and classify it as small, medium, or large using the framework I described earlier. Step 2. If deploying a large or medium amount, open a high-yield savings account or money market fund to hold the undeployed capital during the DCA schedule, ensuring it earns 4 to 5% while waiting rather than sitting idle. Step 3. Set up automatic purchases in your brokerage on a specific date each month, whether the 1st, the 15th, or any other consistent date, and commit to not modifying the schedule regardless of what markets do between purchase dates. Step 4. Decide in advance what you will do with any remaining undeployed capital if a significant market decline occurs during your deployment schedule, because having a pre-written response to this scenario prevents the behavioral failure of canceling the DCA at exactly the wrong moment. A reasonable pre-written rule might be, if markets fall more than 20% from their level on day 1 of my DCA schedule, I will deploy the remaining undeployed capital as a lump sum immediately rather than continuing the scheduled deployment, because the decline itself creates the buying opportunity that makes accelerated deployment attractive. This rule converts a significant market decline from a reason to pause the DCA into a trigger to complete it faster, which is the correct behavioral response to market declines for long-term investors. Step 5. Once your full capital is deployed, stop thinking about the DCA versus lump sum decision entirely, because it only applies to deployment decisions for new capital and has no bearing on how you manage your investments after the deployment phase is complete. That is the complete framework, that is the data, and that is the specific implementation guide for deploying capital in the current 2026 environment. Lump sum wins 2/3 of the time. DCA provides real behavioral insurance for the 1/3 when it does not. High yield rates have reduced the opportunity cost of DCA to near zero in the current environment, and the elevated 2026 valuations shift the balance slightly more toward DCA than the base rate suggests for investors deploying large sums of new capital. Start your deployment this week using whatever schedule fits your situation based on the framework, and see you in the next video. One more thing worth addressing directly, because I think it is the underlying anxiety that drives most of the DCA versus lump sum debate, and naming it explicitly is more useful than pretending the debate is purely mathematical. The real question most people are asking when they debate DCA versus lump sum is not about return optimization. It is about regret minimization. Nobody wants to invest their inheritance or their bonus or their business sale proceeds as a lump sum and then watch markets fall 30% immediately afterward. The pain of that specific sequence of events is so vivid and so emotionally present that it drives people toward DCA even when the data says lump sum has a 2/3 historical advantage. And that is actually a rational response to the specific asymmetry of the regret landscape. Investing as a lump sum and watching markets immediately fall produces a regret that feels personal, specific, and avoidable in retrospect. Investing via DCA and watching markets immediately rise produces a regret that feels impersonal, statistical, and just the cost of a prudent decision. The psychological difference between these two regret scenarios is real even when the financial outcomes are mathematically equivalent over the long run, which is why the DCA versus lump sum decision is ultimately as much a question of which type of regret you can better tolerate as it is a question of which strategy produces higher expected returns. The data says lump sum. The psychology says understand yourself. The silent millionaire framework says both things are true, and the correct answer for your specific situation lives at the intersection of the mathematical evidence and your honest self-assessment of your behavioral response to short-term losses. That intersection, reached honestly and applied consistently, produces better outcomes than either a purely mathematical or a purely psychological approach could deliver on its own. Now, let me close with the clearest possible summary of everything we covered, because I want this to be genuinely actionable, rather than just an interesting framework to file away. The data says lump sum wins 2/3 of the time with a 2.3% average advantage over a 12-month DCA period. High-yield savings at 4 to 5% in 2026 reduces the opportunity cost of DCA to near zero for the cash waiting to be deployed. Elevated 2026 valuations shift the expected return balance slightly toward DCA compared to the historical average. The behavioral risk of abandoning a DCA schedule midway through is the biggest threat to the DCA strategy, making full automation essential if you choose it. The behavioral risk of investing a lump sum and watching it fall significantly is the biggest threat to the lump sum strategy, making honest self-assessment of your risk tolerance essential if you choose it. For most investors deploying amounts under 25% of their net worth, lump sum now is the right call based on the data. For most investors deploying amounts over 75% of their net worth or emotionally weighted capital, 6 to 12-month DCA with fully automated purchases is the right call based on behavioral reality. For everyone in between, 3 to 6 months of automated DCA is a reasonable middle ground that captures most of the mathematical advantage of lump sum while providing meaningful behavioral protection.